All right, well, welcome everyone. So you are all muted right now, but later on we will be able to unmute you and you'll be able to ask questions. You can also send chats to me. I'll be monitoring those in just a little bit. So welcome to our December 3rd Thursday training. I'm Heidi Garvin with GROW Nebraska, and for those of you who don't know, we're a 501c3 nonprofit that supports Nebraska businesses through promotion, market access services, and educational events like this. So if you're interested in learning more, please sign up for our newsletter at grownebraska.org, like us on social media, or email us at info@grownebraska.org. And I am excited to tell you that our sponsor for today's training, our trainings like these would not be possible without our amazing sponsors. And today's sponsor is NBDC, so the Nebraska Business Development Center. And I believe, I'm checking here, I think we have Sarah Bennett on the line, if I'm not mistaken. So I will just be pulling that up quick. All right, Sarah, I think you're unmuted.
Yes, good afternoon. Thank you to Heidi and to GROW Nebraska for partnering with Nebraska Business Development Center and allowing us to sponsor today's session. So obviously some important things coming up with tax season, especially with some recent changes. So a little bit about our center, so Nebraska Business Development Center. We are a statewide organization working with businesses from all stages of development, whether you are simply in the idea phase and trying to figure out which direction to go, to you're ready to get started, do the business plan, financial projections, and go after some financing, even to growth phases and transition. So we do that through about 30 different consultants in 8 locations across the state. And with this, most of what we offer are free services because we do receive federal funding, and that allows us to work with you on a variety of different things from startup needs to working with the federal government and securing government contracts with them. So a full range of services, as you can see on the slide in front of you, that we're happy to work with you on depending on your needs and how you want to grow your business. So we have some information on our website. So we don't have a short website like GROW Nebraska does anymore. We are actually part of the University of Nebraska-Omaha, so it's a rather extensive website. But if you just do a Google search, you can also find our annual report, which includes 12 success stories across Nebraska. We're happy to highlight the achievements of businesses in Nebraska and the things they accomplish because owners work very hard, and we want to highlight some of those things. And we're proud to work with folks to help them at all of their stages. So if at any point you have questions, feel free to seek us out and find somebody that's in your area that can help you grow your business.
Yeah, and following this call, we will be sending out Sarah's contact information as well as a little bit of information about the Nebraska Business Development Center. It'll have a link to their website and where you can read those success stories. So it should be wonderful. So thank you, Sarah, for helping us out today, being our sponsor for this 3rd Thursday training. And if you enjoy this training today, or if you have any suggestions for improvement, I'll also be sending out a survey immediately after the call with upcoming dates, as well as that contact information for Sarah and for our trainer today. So if you enjoy this training, our January 3rd Thursday training is going to be on getting your Husker licensing, protecting your brand, and it'll have a bit about our 2018 Marketech Conference as well. We're super excited about this. So if you save the date for March 15th, 2018, we're bringing in Instagram guru Jen Herman from Jen's Trends in San Diego. She's going to be our keynote speaker. But now, the reason we are all here, I am going to go ahead and turn it over to J'Nan. So J'Nan, if you give me just a second, I will unmute you. see. Okay.
Okay.
I can hear you
welcome.
now.
Thank you so. Okay, great. Thank you so much for having me. I am not finding my screen to share.
If you hover over the bottom, there should be a share screen button now.
Okay. I'm just not seeing my PowerPoint presentation. Try. There it is. Okay. There we go.
Perfect.
Okay. As Heidi said, my name is J'Nan Ensz. I am a CPA and Beatrice, but I do a lot of traveling across Southeast Nebraska. I also have an office in Fairbury. So I'm really happy to be with you today. Have just spent the past 2 weeks doing tons of tax planning, so this is all really fresh on my mind. And with the passage of I just saw them sign it, actually. I saw the Republicans sign the new tax bill before the session started. So looks like it's going to be the real deal. I will just go ahead and jump right in, and let's talk about what we're going to talk about today. I want to do a quick recap of what the new tax legislation will mean for 2018. Pretty much no changes for 2017. Everything is going to be effective for the most part of 1/1 of 18. So we'll go over a few things. We only have an hour, and I want to do leave time for questions. So we're probably going to go through these fairly quickly. Might have bit off more than I can chew with how many topics I said we would cover, but we'll give it a whirl. Definitely going to talk about Section 179 deduction. Someone had, when they signed up, had sent in that they had a question. They wanted to help understanding what that is. That's a depreciation deduction for your small business. We're going to talk about the possibility of getting a tax deduction by paying your kids to work for you in your small business. We're going to talk about some health insurance issues with the Affordable Care Act mandate and some of the pitfalls with the premium tax credit and some issues that I have seen clients run into with repayment of the subsidy. And then we'll talk about, this is probably, entity selection is probably its own webinar, but we'll just touch on it briefly because these are decisions that you might want to be thinking about as you look at how your 2017 year is going to end up and making a decision about if you are a sole proprietor, if it is time to look at perhaps incorporating or creating an LLC for your business. So with that, we will just get into the 2018 tax bill update. Basically, the standard deduction is going to almost double. It's going to go from $12,700 to $24,000 if you're married, filing jointly. If you're single, it's again about double, $6,350 to $12,000. What that means is that you are, if you don't itemize, you're getting a big boost there. That's going to be a fairly substantial deduction, so that if you never were able to itemize before, you're going to get a much larger deduction. One of the negative aspects of the bill is that there is the elimination of the personal exemption. From what I can tell is for you, if you're married, you and your spouse and your dependent, for 2017 and prior, were given $4,050 per person, and that was a reduction of your taxable income. That is going away. And what it looks like for me, that's actually probably going to hurt me personally. I have 5 children. Actually, one of them's no longer living at home. He's on his own now. So I'm losing out on 6 personal exemptions. So for larger families who don't itemize, that might actually be kind of a bitter pill to swallow. But I will tell you overall, I think the tax bill will be good for small businesses. They are lowering the individual tax rate as well, but we'll talk about that a little bit more going forward. If you do itemize, there is a cap now on how much you can deduct for state, local, and real estate taxes. So you still are allowed to make those deductions, but if it's more than $10,000, there is a cap. So again, you would have to be able to itemize more than $24,000 to start with to even, because the standard deduction is so high now at $24,000, you would need to be able to itemize more than $24,000 for it to even pay for you to take the itemized deduction. Mortgage interest does remain deductible if you itemize, so nothing changed there. I was really glad to see that they left this in, especially for my clients who are not-for-profit corporations. The charitable contributions do remain deductible. One of the bills, I can't remember if it was the House or the Senate, had taken that off the table, and that caused quite a stir. But not only did they leave it in there, they are actually increasing. In the past, you couldn't contribute more than half of your taxable income. Now they're raising that to 60%, so that's a good thing. Miscellaneous itemized deductions are no longer deductible, and that would be advisory and tax prep fees, employee business expenses. Those are not going to be deductible any longer. I would say for most of you on the call, if you're self-employed, this wouldn't affect you because your expenses are deductible because they are part of your business, so they would be on your business return. So this should not affect you. Tax credits, child tax credits are going to increase from $1,000 to $2,000 per child. So that is right off the tax. That's not a deduction. That is actually a reduction of the tax, not your taxable income. So that's a good thing. This is something additional. If you have a non-child dependent who either they're 17 or older, they're an ailing parent or an adult child with a disability, you would be eligible for a $500 credit. That has not been there before. So that is a possible benefit to some folks out there. Provisions that are going to remain unchanged. The capital gains rates are at the same level as they have been. There's some confusion on what is a capital gains rate and what that means exactly. If you sell property or sell an asset that is subject to capital gains laws, that income that you have made on the gain from that sale is a lower rate than income tax rate. Even with the reduction in income tax rate with this tax bill, capital gains rates are still lower than income tax rates. So nobody likes paying taxes, but if it's a capital gain, it's actually a lower tax. So that's positive there, but that it isn't changing. But just a lot of people don't understand what the difference is and what a capital gain rate even means. School supply for teachers. Not sure if we have any. Probably don't have any teachers as self-employed people out there, but maybe one of your spouses is a teacher. That deduction is going to stay there. There was talk that they were going to remove that deduction to adjusted gross income. Education credits are not changing. Student loan interest is still deductible. So those are good things that we're glad to see that didn't get taken out. And if you are in a low income bracket, earned income tax credit is still available, and the adoption credit stays. So those are good things. I'm sure that there are questions that you will have. I've gone through these pretty quick, but this is basically just a really quick summary of the changes that just happened. So basically, anything new here, you're going to see that take effect 1/1 of 2018. One thing I did advertise when we were talking about what I was going to talk about today were some tax planning ideas, which I did not get into my slide presentation because because the law just passed. We weren't really sure exactly what was going to stay in and what was going to go out. So if you've got a pen and paper, you might want to take notes on this as small business owners. You will want to prepay your 2017 state income tax because it will be easier. If you itemize, it'll be easier to get that deduction in 2017 than 2018. Probably, if possible, now there's not a whole lot of time to plan because we only have about a week left, and it's kind of a short week because the 31st is on Sunday. So really, the last business day is the 28th. So we lose sorry, it's 29. I'm already looking at a 2018 calendar. Because tax rates are going down both individually and for businesses, it might be wise, if possible, for you to push income into 2018. So you might, if you've got somebody that you're trying to collect from, if you could even negotiate with them, hey, don't pay your bill until January 1st. Now, on the flip side, they may want that deduction in 2017 for their purposes, so you might have some trouble negotiating that one. But if you do have the possibility of pushing income into 2018 because of the lower rates, that we might find that beneficial. Those are the main things that I think affect most of my clients. The other option too is if for some reason you would be looking at purchasing a business vehicle that you also use for personal use, if you use it for more than 50% personal use, that might be a purchase that you would want to push into 2018. Now that may seem like that's just the opposite of what I said, because I said we want to put income into 2018, but there are limits on how much you can deduct on a vehicle that is not 100% business use, or what they would consider luxury auto. The depreciation on a luxury auto goes up substantially in 2018. So if you are thinking of buying a car for a Christmas present and it's a business expense, a business car, you might want to push that into 2018. So we will move on to depreciation. We're kind of just touching base on that. The first thing to understand about depreciation is you have to decide whether it's an expense or a capital expenditure. Basically, a capital expenditure is something that's going to last more than 1 year. It's not what I would call a consumable. So generally, you're talking about hard assets like furniture, equipment, fixtures, things that are going to last a while, that you would that the IRS would require that you depreciate. One of the benefits of this Section 179 deduction is it's part of the tax code that says that you are allowed to immediately write off the purchase of that equipment. So normally, let's say you bought a $25,000 piece of equipment. Normally, you would have to depreciate that over 7 years. So you get to write the whole thing off, but it'd take you 7 years to do it. What the Section 179 deduction does is allow you to write that all off immediately in the year that you purchase it. And you can choose how much you want to write off, but you only get that choice the first year. You can't say, well, I'm going to write off half of it this year and I'll write off half of it next year. Whatever you write off this year, if you don't write it off 100%, whatever you leave for future years, that's going to get depreciated over the life of the asset, generally 5 or 7 years, depending on what kind of asset it is. So the whole idea to remember here is rapid write-off, and that allows you to get a big chunk of expense all at one time. One thing I don't want people to do, and I always advise against it, is do not buy something just to reduce your taxes. If it's not something you need, if it's, or if the biggest issue is, do you have the funds to pay for it? You do not want to be buying assets just to lower your tax liability, because it's not a dollar for dollar deduction. It doesn't reduce your taxes dollar for dollar. What happens is, let's say you bought $10,000 for ease of calculation. You bought a $10,000 piece of equipment. Depending on what tax bracket you're in, that's only going to reduce your taxes $2,500 to $3,000. So sometimes it's actually better, if you're short on cash, to just pay the tax, because then you look at it as, I pay a lower tax, but now I have $10,000 I've got to find the cash or to pay for. I've got to take out a loan. So generally, I always advise against that. That generally is never a good idea. But having said that, if you do have the cash, or it is something that you really need and you're trying to decide, oh, should I buy it this year or should I buy it next year, this is a really good tax planning tool that I use a lot with my clients to determine their tax liability. It, like I said, it comes straight off your taxable income from your business and allows you to just write it off immediately instead of doing it over the life of the asset. So if you have questions on that, hopefully we can cover that. We'll have time at the end of the presentation if you have questions on that. So here is just one thing that they did change, and it's not in the slide, but the Section 179 became permanent. Prior to this, they were always having to do an amendment to the bill or say, yes, we want an extension to this tax deduction. It is now permanent through 2023. So for a good long while, you have the ability to do the rapid write-off. There is a limit, but for most of my clients, that limit doesn't matter. 2017 and prior, it was $500,000. You couldn't write off more than $500,000 of assets in 1 year. Generally have not seen that to be an issue with the clients that I deal with, but if that's you, more power to you. Good for you. In 2018, they doubled that. So now you can write off $1 million worth of assets in 1 year if you have that expense. So just something to keep in mind. For most of my clients, the limit is generally not an issue. And there it is. I actually did put it in the slide. Okay, I want to move on out of depreciation into a little known deduction that a lot of self-employed people are unaware of, is putting your kids on payroll. Now, one of the caveats to that is it has to be your child, and you can only be a sole proprietor or a partnership. If you're an S Corp or a corporation, this deduction is not available to you. You only can put your kids on payroll and save some of these taxes if you're a sole proprietor or a partnership. And the great thing about this is that wages are not subject to Social Security or Medicare tax. So, generally that is not a tax that you can avoid if you pay wages, even if you have so many allowances that you have no income or federal or state income tax, you always have Social Security and Medicare. Your children are not subject to that if you put them on payroll. Now, obviously, they have to really be working for you. It isn't just, hey, I'm gonna call this wages. It needs to be bona fide work. They need to fill out a timesheet. It has to be a job that they are doing for your business. So that is obviously something. If you were to be audited, the IRS would come in and look at that and ask for records, timesheets. What was your child doing for you? So it doesn't look like just a tax-free or a tax-deductible allowance that you're giving them. The wages on payroll tax returns, and you do have to file a W-2. So there is, if you don't already have payroll, this might be kind of a pain, because now all of a sudden you're going to have to start filing payroll tax returns. So a lot of my clients who don't have employees, who are sole proprietors or partnerships, they're like, oh, I don't want to mess with having to file payroll tax returns. But if you want a little bit of headache, and generally I suggest that you don't do your own payroll, that you find a trusted advisor who knows payroll law and have them file your tax returns, your payroll tax returns for you, because they will know the law. They'll know what, make sure that you're in compliance. But if you do want this deduction on your business tax return, then you do have to report those wages, the wages that you pay your child. You have to report them on Forms 941, 941N, and you do have to file a W-2. Unfortunately, once your child is adult age, this is not possible anymore. It's only for children under 18. So if you have a child who's still a dependent, still lives at home or is in college, maybe they come home on the weekends or come home at summer, if they're over 18, then this does not apply to them. You would have to treat them like you would any other employee. one of the great things about this too is if the child's earned income is under $6,300 and you are claiming them as a dependent on your tax return, they're not even required to pay or to file a tax return because they're under the limit. So you potentially, you get if you said, I'm going to pay them $6,299, you will get a deduction for $6,299, and they have no reporting requirement. There is no tax due on those wages. If they make more than that, then they do need to file their own tax return, and they will be subject to some federal and state income tax. But if they're under that threshold of 6,300, it's basically it's a full deduction for you and not taxable to your child. So that's a really excellent piece of advice if these things apply to your business. Okay, the next thing I wanted to talk about is, what is your tax preparer looking for? I get this question a lot, especially when I get new clients, like, what do you need from me when you do my taxes? And really the easiest thing is, if you're a sole proprietor, I just went to Form 1040 Schedule C. This is a Schedule C. And these are the things that your tax preparer is looking for. And they would love to have them itemized into these categories. So pretty much all of these are self-explanatory. Depletion on line 12 is probably not applicable to anybody. Employee benefits, that would be if you pay a 401k on your employees. Any interest expense, legal and professional, it just goes down the line. They try to cover all of the aspects of what business owners, how they categorize their expenses. One thing that you will see down on line 27A is other expenses. We really want to keep that to a minimum, because what happens is, and I'm going to go to the next slide. Actually, I'm going to go ahead a little bit. This one right here. If you see where that arrow is, there is a code, the business code on. It isn't even just a Schedule C. It is any business return. You are supposed to put a code in there to say what that defines your business. And if you're a retail store, if you only sell online, if you're an insurance agent, if you're an accountant, if you have a nail salon, each one of those has their own code. And so what happens is, I'm going to go back to this slide here. Your tax return goes into a VAT with all the other tax returns that share the same code as your business. The IRS puts that into a big database, and they look at just those with that particular code, and they look to see how your numbers line up with the averages. So they're not looking at dollar amounts, they're looking at percentages. They're looking at what is the income and what percentage of your income do you spend on advertising? What percent of your income do you spend on office expense? Okay, so I always use the example, an insurance agent is going to have a lot of meals and entertainment because they wine and dine their clients, or an investment advisor. They have a high rate of meals and entertainment. And so under that code, you would expect to see a high number. Let's say you have an auto body shop. The IRS would not expect you to have a very large meals and entertainment, because they're assuming that you are in your shop fixing cars and you're not out with your clients taking them out for meals. That's not a normal expense for an auto body shop. So we want to be able to get these things on their proper line as much as possible. Obviously, there'll be things that fall into other, but when that other line gets really big, that may raise a red flag and may set you up for potentially for an audit. So I always try to get my clients to get their expenses to fit into lines that are listed. One of them that usually stands out is, you don't want to put telephone in with utilities. So telephone often goes on its own line item into other expenses. But generally, the IRS is really hoping, can you get your expenses to fit into these categories? So talking about what's deductible, ordinary, it's common and accepted in your line of work. So just like the meals and entertainment, or like a nail salon. you're going to see hair care products, and you're going to see supplies for nail polish, or I should say hair and nail salon. You might see those. Those are common and accepted in that line of work. Me as a CPA, I can't write those things off because they have nothing to do with my business. So where it's deductible for one person, it may not be deductible for somebody else. And it has to be necessary. Is it helpful and appropriate for your line of work? So those are the questions that we want to ask. And the need, it doesn't have to be required in order to be considered necessary. So it could be your choice if you want to spend it, but it would be something that is necessary for you to run your business successfully. So those are the two words to keep in mind when you're thinking about what can I deduct, and making sure that what you're giving your tax preparer are truly things that are deductible. I will say for the most part, the tax preparer is trusting you to understand what the laws are, understand what is and is not deductible, and if you are not sure, that's what they are there for, to answer questions and hopefully to educate you, to tell you, no, those things wouldn't be deductible. Yes, that would be. We're not going to get into it in this webinar, but I have done sessions on travel and entertainment. When is travel deductible? When can I take my family with me and still make it deductible? So there's some specific rules to that. So you want to make sure that unless you are giving your accountant, your tax preparer, all of your receipts, he or she is relying on you that the things that you are putting in those boxes are actually deductible. Expenses that that are most often reviewed by the IRS is the home office deduction, auto expense. So that would be personal use of vehicle in relation to business use of that same vehicle. And as I said, travel and entertainment, those are the ones that are often looked at. Record keeping is really vital, and you really want to be doing that throughout the year. The benefits of good record keeping is it's going to allow you to determine the profitability of your business. It'll help you make good decisions about whether you can afford to take out a loan to buy a piece of equipment. Are you going to be able to pay that debt back based on your profitability so far? It'll allow you to prepare reliable financial statements so that if you do need to go get financing, a banker is going to want to know those things. And not having good record keeping can really shoot you in the foot. It can keep you from getting financing that you need, and just give your banker a sense of unease that, wow, you don't have statements. How do you really know where you're at? Can you really tell just because you have cash in your checking account? This is a true story. I had a client that their bank account was, I mean, they weren't my client at the time. I got them after they found out they had a problem. Their bank account was growing. They had a lot of money in the bank, and so they used that money to do some remodeling, to update their business. Later, it turns out, after their bookkeeper quit, the bookkeeper was not making payroll tax deposits for the employees. And the reason there was so much cash in the bank was because she was not remitting her payments to the IRS and to the state. And so having accurate records and keeping track of those records could have avoided that. They ended up having huge penalties and owed a substantial amount of tax. And sadly, because of that, the business ended up closing because they couldn't handle all the money that they owed. And had the owner known, they said to me, I would never have done that remodeling had I known that cash really wasn't my cash. So having reliable financial statements really is vital. And bottom line, what is your tax preparer looking for? It's support for the items on your tax return. If you ever face an audit, you are going to need to have good records so that the IRS can, they're going to do sampling, and they're going to want to know, well, what makes up supplies? And they're going to want to know exactly what makes up supplies, what makes up your automobile expense. So record keeping is vital. This is a good slide. Hopefully you'll print off the handouts that Heidi said would be available to you. there is good help at the IRS for small business record keeping, and just knowing what's deductible, what's not, what are appropriate business expenses for my line of work. You can go to irs.gov and search these keywords, or there's specific publications for small businesses, taxable and non-taxable income, and also just what do you need when you start a business. So I would really, really urge you to go to irs.gov to get more information on these specific things. Okay, health insurance issues. I don't know how many of you are affected by Obamacare, by the Affordable Care Act. I have a number of clients. Basically, that's what I've been doing for the past 2 weeks, is trying to estimate what my self-employed clients are going to earn so that they know if they're eligible to go to the marketplace, or what kind of subsidy that they might be eligible for. And it's pretty tricky business. If you're self-employed, it's kind of difficult to know what you're going to make. Not only this year, we're still trying to figure out, well, what's my bottom line for 2017? Really, what the marketplace is wanting is, okay, what are you going to make for 18? And that's, especially with the new tax laws, that's kind of some dangerous waters there that we can tread. One of the issues is the premium tax credit. Many people are not aware that when they sign up at health insurance through exchange, and they see, oh, I qualify, I only have to pay $200 a month, and that's all they're thinking is $200 a month. What they don't realize, and I don't believe that the Affordable Care Act has really made clear to people, is that it's costing you $200, but the government is picking up probably $1,000 of that. It depends on, if you're married, single, if you have dependents, whatever. But that premium probably is really costing $1,200, but you don't see that. You just see, I only have to pay $200. The government is keeping track of that $1,000, and that $1,000 is being given to you in advance as a premium tax credit. The negative impact of that is, if your income is higher than what you estimated, it is very likely that you will have to pay some, if not all, of that premium tax credit back. And that can be a very painful conversation that your tax preparer has to have with you. I had one of those last year. They did not tell me that they were on the exchange, that they had gone to the marketplace. They just said, yeah, we have insurance. Come to find out, I get the 1095-A from the government that says, here's what your subsidy was. They had sold some property. That property had a nice gain, and their taxable income doubled. They were responsible to pay back $14,000 of premium tax credit that they didn't even know they were getting. So it's very important, if this is something that affects you, that you are aware that that subsidy could come back and have to be paid back. So, it's kind of difficult, but you've got to know your income. You've got to know what your subsidy is. Those are really vital pieces of information. And you need to know that there is repayment that's required if you're over the threshold. Some good news is the Affordable Care Act mandate, which required you to have health insurance. And it started out, I think, 3 years ago that there was no penalty. And each year it's gotten more and more to where some people were paying a couple thousand, maybe $3,000 for not having insurance. It was a tax that was added right back to their taxable income at the end of the year. That is going away. That fine is being repealed. Unfortunately, not until 2019. So for 2018, you still do have to prove that you have health insurance, or there is going to be a penalty. One of the things I'm excited about that there was a change in the law is something called the QSE-HRA, a Qualified Small Employer Health Reimbursement Arrangement. And what this is, it's a way for employers to help their employees get reimbursed basically for medical expenses that they've had to pay themselves, and it's tax-free. They can use, so what's happening is the employer would set a threshold basically, and there are many rules associated with this, so it'd be something that you would want to look into. And you have to have a plan in place, so you have to go through a benefit administrator. So it's not something you can just do on your own and just start paying people's health insurance premiums or their medical benefits. But once you get a plan in place, it allows you to reimburse your employees up to a certain amount that you specify, and it's totally tax deductible to you, and it is not taxable as income to the employee. Right now, or before they enacted this law, if you wanted to give your employees some extra cash to be able to pay their out-of-pocket health insurance premium that they carried somewhere else because you couldn't afford or you didn't carry health insurance, that was taxable. It was deductible to the employer, but it was fully taxable. Social Security, Medicare, and federal and state income taxable. So it was still a benefit, but it wasn't as good a benefit as it could have been. So again, the employee portion is tax-free, and the employer portion is completely 100% tax deductible. Now, one thing to take into account, like I said, if you have, if you are on the marketplace, again, this is only for employers who are not carrying health insurance as it is. They're not offering health insurance to their employees. If you as an employee are have a mandate or are subject to the exchange, you're getting a subsidy, that is going to reduce your benefits. So that's something that you need to take into account. Okay, our last slides are on the entity structure, and I'm looking at the time, and we're at, I think I want to leave about 15 minutes for questions. So I'm going to go through these really quickly so that I want to give you time. 15 minutes, I'm sure, is probably not enough to answer everybody's questions, but I do want to give you some time. So I'm going to go through these really quickly. This is just to get you to start thinking about it, and so that you will talk to your tax advisor about these issues to see if it's right for you. There are different types of entities. So there's sole proprietor, partnership, corporation, either a S Corp or a C Corp. And then there is the interesting one, the limited liability company, which is a whole different animal, which many people do not understand what that means. Sole proprietor, I'm just going to flip through the benefits here real quick. No formal documentation, but it is a very expensive tax that you pay on self-employed earnings. Not only do you pay the whatever tax bracket you're in for income tax, you're going to pay another 15% of self-employment tax. So it's a very expensive tax. It's filed right along with your tax return as a Schedule C. It is not considered a separate entity. And the nice thing about it is that losses, if you have a small business, you show a loss, those losses aren't limited. They just reduce your taxable income, which is generally of benefit. A partnership is similar to a sole proprietor, except that means there's more than one person. You don't have to have a formal agreement, but it's advisable just so, because it's not just you anymore, there's two or more of you, and you want to make sure you're all on the same page with how the partnership's going to operate. Now it's a separate tax return too. It doesn't flow, it is not part of your 1040, but it flows through as income or loss from the partnership return onto your individual 1040. The partnership itself is not taxed, and just like a sole proprietor, those earnings that you are subject to the 15% self-employment tax. So again, that very expensive tax. Unfortunately, in a partnership, the losses are limited. So you can't necessarily just write off everything. You know, if your share of the partnership shows a loss, you may not be able to just write it all off like you can with a sole proprietor. I'm not going to go into more detail because it's going to get too complicated and we don't have enough time for that. But it's a conversation that you'll want to have with your tax advisor. Separate entity files Form 1065. The next one is a C Corp. This one is required by law that you file articles of incorporation. There's an S Corp or a C Corp. The C Corp is the default. for incorporating with the IRS. You have to do something special if you don't want to be a C Corp. The C Corp pays the tax, so this does not flow through to your personal return. This is where the really good news of the tax bill that just passed is that corporate tax rate went from 35% in 2017 to 21% in 2018. So that is a huge reduction. That's like a 14% pay raise that these corporations are going to get. And there it is. One of the drawbacks is that dividends are taxable to the shareholder. So if you take money out that isn't wages, you're going to get taxed as a dividend, just like if you had stock in AT&T or Microsoft. There's double taxation on that, and you file a separate tax return, a Form 1120. Schedule a C Corp or an S Corp is similar to a corporation. You have to do the articles of incorporation, but you need to make an election to file as an S Corp. Now is where it's not its own tax anymore. It flows through to the shareholder's personal return. So the S Corp itself pays no tax. And like a partnership, losses are limited. You can't necessarily just write off a loss. You have to find out whether you have basis. Again, that's for a different discussion. But those losses or earnings flow through to your personal tax return. There's no self-employment tax, which is one of the benefits of an S Corp, but you have to take reasonable compensation. And the great thing about an S Corp that makes it very popular is that dividends are not taxable to the shareholder. So as we showed in the S Corp, in an S Corp, the dividends are not taxable. In a C Corp, they are taxable. So I know I'm going through this really fast, but hopefully it just gets you thinking, and you'll want to have a conversation with your tax advisor to help you understand what's going on here. Now, this is a different animal, limited liability company, an LLC. Very popular. Not as many requirements as an S Corp or a C Corp. They're much more laid back. You do have to file an article of an organization instead of articles of incorporation, kind of the same thing, but just called something a little different. Here's where it's different. It's a disregarded entity, meaning that it is not, the IRS does not recognize it. It is a non, like I said, a disregarded entity. So what you decide is, what kind of limited liability company are you going to be? You can be a sole proprietor limited liability company. You can be a partner limited liability company, or a corporate limited liability company. So it all depends on what you choose, how that's going to flow through to your personal tax return. So there is no tax return for an LLC. You have to decide what kind of LLC you want to become. Okay, so that was down and dirty. I will open it up. We've got about 12 minutes. And Heidi, if you want to open it up for questions, I'd be happy to see what I could.
Real quick, we did have one question come through on chat for you from Stephanie.
Okay.
She would like to know if your employer doesn't offer health insurance and you don't carry insurance, how much do you get penalized for?
This year in 2017, I'm going to have to, it changes every year. It goes up every year. And I'm sorry, I don't have that exact number. But Stephanie, if you will give your email address to Heidi, I would be happy to give you that exact information so that I don't want to misquote, because it goes up every year, and I don't know what the 2017, but you are right. For 2017, you don't have health insurance and your employer doesn't, you will be subject to that, basically that penalty.
Got it. And she just sent it to me, so I will forward it on to you.
Okay, perfect.
All right, and now we are going to unmute everybody and let you chime in with your own questions. You might have a little bit of feedback here for a second. Perfect. It looks like you are all unmuted. So we'll open it up.
One question I could, somebody had emailed a question. I have those. I forgot to mention that. Someone had asked about how to use a solo self-directed 401k for future investment purposes. I'm not sure if that person is on the call. Basically, you are allowed, you're the employer and the employee, so you would have to be either an S Corp or a C Corp in order for this to work. That you could have up to $18,000 of deferral from your wages, and you could contribute in addition to that up to 50% of your salary. So overall, between what your deferral is and what the employer can contribute, up to $54,000. So as long as it's not more than what your salary is, you can't contribute more than what your salary is. But I'm not sure if the person who wanted answers to that is on the line. But again, if you send your email to Heidi, I would be happy to respond directly to your email.
Excuse me, what was that called again?
A solo self-directed 401k. So that's basically you are an S Corp and you are the sole shareholder. You're the employer and the employee.
Okay.
Yep. And we did get a question through on chat. Dana would like to know regarding deferring income to 2018. Is it okay for your customer to write you a check and mail it on December 31st, 2017 to get the deduction in 2017?
Yes. If they are mailing the check, because it's all about constructive receipt. So if you do not have that check in your possession on January 1st, obviously you wouldn't have it on January 1st because that's a holiday, but if that does not come into your possession, now it can't be that it's sitting in your mailbox and you just haven't gotten your mail, but if they're putting it in the mail on the 30th, you're not going to receive it before, so they actually can get the deduction in 2017 and you don't have to report the income till 18. So if you can work that out with your customer, that's very very doable.
Awesome. And Peggy would like to know what qualifies as an exemption to the penalty for not having Obamacare approved health insurance.
Your income, there's a threshold if you make below a certain level. I think it's 400% of the poverty level. Again, those are calculations. If you would happen to have, there's a very popular option that many of my clients are using now. It's Christian Healthcare Ministries. It's not health insurance. It's just a co-op of helping people pay for their health insurance, or not health insurance, but their health bills, their physical, their physician payments and things like that. It's not health insurance, but it is allowed by the IRS as a qualified exemption. So again, it really depends on what your revenue is. If your revenue is under a certain threshold, then you wouldn't be subject to the mandate. So if you would like to know what that threshold is, I would need some more specific information from you about what you think your taxable income is going to be, and then I can tell you whether you qualify or not for an exemption.
Got it.
Well, more likely than not, it wasn't that everybody totally understands what I said. Probably everybody's feeling a little overwhelmed by by what I said, which is totally understandable. It's new waters for us as tax preparers too. But as I have mentioned, if you give Heidi your email address, very happy to answer any questions you might have as best I can. Obviously, without doing some actual tax planning, there are certain things I wouldn't be able to tell you without having specific information.
Right. It looks like the questions we have coming in on chat are mainly about the health insurance.
Okay.
So we have one here that is asking if an exemption is an exemption, the cheapest bronze plan, that the cheapest bronze plan is higher than what you have.
If the cheapest bronze plan is higher than what you have, I would assume that means that your income has been estimated to be lower, so that the credits that you're getting you wouldn't have to repay those, that you would be eligible for the full amount of the tax credit.
Got it. And if you have a medical, dental, like an RX discount card, does that apply to the exemption that you were talking about?
Well, if you have like an HSA, is that what we're talking about? If it's an HSA,
She says no.
okay, read the question again.
If you have a medical, dental, and prescription discount card, does that apply to the exemption you were talking about?
Oh, if it's just a reduction of what you would pay to a provider. It has to be health insurance.
Is that yours?
Unless you qualify.
Oop, hang on, J'Nan.
Sure.
Okay, sorry. If you want to go ahead and continue.
Sure. If you only have just the discount card, just that you get a break on what you're paying, that is not considered minimum coverage. You actually have to meet the requirements and pay the premium or sign up for the marketplace and sign up for one of those plans. But if you don't have a health insurance plan, you may qualify. Again, it really is so dependent upon what your income level is. Sorry, I sound like a broken record, but and those laws are pretty detailed, pretty strict, and like I said, it all is dependent on what your income is.
Got it. Well, Janet would like to know what the look back period is when you're going from a C Corp to an S Corp.
Okay, if you are if you're a C Corp right now and you want to change to an S Corp, you have 2.5 months to decide that you want to be an S Corp. So if you're already a C Corp, if you can make a determination before March 15th, you have that long to make it retroactive back to say, I want the whole year to be as an S Corp. There are some, it depends on if you have built-in gains. I mean, that's a complicated decision that you would need to look and see because you have a 5-year look back period. You look back 5 years to see, I'm sorry, I'm talking out of both sides of my mouth right now. To make the choice to move to an S Corp, you have to make that decision within 2.5 months. Whether there is taxability for making that change, they look back and you have 5 years where if you sell assets that you had as a C Corp and you sell them for a gain, you're going to be taxed on those things even as an S Corp. So there's some calculations that you need to go through with your CPA to determine what the taxability of those assets, those hard assets that you'd be selling. That's pretty much what they're looking at, is your hard assets that you're selling in those 5 years. If you sell nothing, you decide, I'm just going to wait. I'm going to wait out that 5 years. Then there is no built-in gains tax, and you can move on to be an S Corp without any tax issues. What I will say right now is, being a C Corp right now is, generally it was, I want to be an S Corp because of the flow through and because you're taxed at an individual rate, not at the corporate rate. Right now with the C Corp having moved down 14% from a 35% tax rate to a 14% or a 21% tax rate, that's a pretty significant reduction in tax. I've got one C Corp. So we were looking at, you know, should we switch to an S Corp? And they decided to stick it out as a C Corp because they felt like they could save more money. But having said that, again, those are big issues that you cannot just decide based on an hour webinar. Those are some specific allocations that you need to look at, and some serious tax planning that you need to do based on what's your reasonable compensation you have as an S Corp. How many distributions do you take as an S Corp? Because those things change if you change from a C Corp to an S Corp or an S Corp to a C Corp. So.
Well, Janet thinks you explained it very well, and she says thank you.
Okay.
Well, it is 1 o'clock, so I am going to wrap this up here. In about 5 minutes, you should be getting an email with a short survey. It'll have some additional information. If you didn't get to download J'Nan's slides, those will be in there as well. It'll have J'Nan's email address if you have any additional questions. And J'Nan, I'll be sending you the email addresses that I got as well.
Okay, perfect.
So thank you so much for doing this training.
Thanks, J'Nan.
Yes, Merry Christmas.
Merry Christmas. Shout out to our sponsor, NBDC, for sponsoring. And I hope you all have a wonderful day.
Thanks, Heidi.
Thanks.